Marcus opens a brokerage app and types $50,000. Ryan signs a mortgage and hands over $50,000. Same day, same amount, same goal: build real wealth. 20 years later, one of them has $170,000 more than the other. And the one who came out behind? He thought he was the smart one the entire time. Marcus is 32, works in tech, earns $75,000 a year. He's been saving for 3 years, and he finally has $50,000 sitting in a savings account earning 4.5%, and it's killing him because he knows it should be doing more. Marcus believes in simplicity. He's read the books. He understands what compound interest does over time. Total market index fund, low fees, long time horizon. Let the market do the work. He opens his brokerage app one Tuesday morning, types $50,000, clicks buy, sets up a $500 automatic monthly contribution. Then he closes the app and goes back to work. Ryan is also 32. Same city, same income bracket, same $50,000. But Ryan's grandfather owned property. He grew up watching rent checks come in every month. For him, wealth has always been something you can touch. Ryan doesn't trust the stock market. He watched his parents panic sell in 2008 and lock in losses they never recovered from. He wants an asset that doesn't disappear when the headlines turn red. He puts $50,000 down as a 20% payment on a $250,000 rental property. 3-bedroom house, solid neighborhood, strong rental market. 30-year mortgage at 7%, monthly payment $1,330. He finds a tenant immediately. Rent $1,800 per month. On paper, that's $470 in monthly cash flow before anything else. Ryan tells his friends. They're impressed. Marcus tells his friends. They nod politely and change the subject. That difference in how it feels is going to cost one of them a significant amount of money. And not the one you'd expect. For the first year, Ryan looks like a genius. $1,800 hits his account on the first of every month like clockwork. He's claiming mortgage interest on his taxes. His equity is building with every payment. He tells everyone about his $470 a month in cash flow. Marcus looks fine. His $50,000 grew to $55,000 in year 1, then $60,000 in year 2. It doesn't feel like anything is happening. Just a number on a screen that moves up a little, down a little, then up a little more. But here's what Ryan's $470 in monthly cash flow actually looks like when you open every envelope. Property taxes, $2,500 per year. Insurance, $1,200 per year. Maintenance and repairs, budget 1% of the property's value annually. That's $2,500 per year, $208 per month. Some years, it's a $200 faucet fix. Some years, it's a $7,000 HVAC replacement you cannot delay because it's July and your tenant is threatening to leave. Vacancy. The average rental property sits empty 1 month per year. That's $1,800 in lost rent every single year. And if Ryan hires a property manager, that's 10% of monthly rent, $180 per month gone immediately. Let's say Ryan manages it himself. He's saving $180 a month, but he's working for it. Late night maintenance calls, weekend showings, coordinating repairs on his lunch break, not getting paid for any of it. After subtracting property taxes, insurance, maintenance reserves, and vacancy, before counting us a single hour of his time, Ryan's real monthly cash flow isn't $470. It's closer to $60 to $120 per month. That's the number on the spreadsheet most real estate videos quietly don't show you. Before we go further, I need to give Ryan something back. Because the cash flow story isn't the whole story. And if I don't show you this next part, I'm not being honest with you. Ryan's secret weapon is leverage. He used $50,000 to control a $250,000 asset. When that property appreciates 3.5% in a year, he doesn't gain 3.5% on $50,000. He gains 3.5% on $250,000. That's $8,750 in equity growth on a $50,000 investment. A 17.5% return just from appreciation. Marcus used $50,000 to buy $50,000 of assets. 10% on $50,000 thus is $5,000. Ryan's leverage multiplied his gains by a factor of 5. That's the primary reason real estate creates more millionaires per capita than the stock market in most wealth surveys. And it's the reason this comparison is never as simple as the thumbnail makes it look. But leverage amplifies both directions. If Ryan's property drops 10% in value, And yes, that happens. His equity doesn't drop 10%. It drops $25,000. On a $50,000 investment, that's a 50% loss in equity. And he still has to make that mortgage payment whether the unit is occupied or not. Marcus's worst year in the past 30 was a 37% market drop in 2008. Brutal on paper, but it recovered completely in 3 years. He never had to make a payment regardless of performance. By year 10, here's where they actually stand. Marcus, $50,000 plus $500 per month, plus 10% average annual return. Approximately $180,000 to $195,000 in liquid assets. Zero debt, zero management. He has spent maybe 10 hours total reviewing his portfolio over the entire decade. Ryan, property now worth approximately $352,000, compounding 3.5% annual appreciation. Remaining mortgage balance, roughly $167,000. Equity, approximately $185,000. Total real net cash flow after all costs over 10 years, $7,200 to $14,004. Time invested, a conservative 400 plus hours. Capital expenses over the decade, $15,000 to $25,000. Let's put that sides by side. Marcus, $180,000 to $195,000 in liquid wealth. Ryan, $185,000 in equity in an illiquid asset, plus some cash flow, minus hundreds of hours. They are almost exactly equal at year 10. And that surprises almost everyone who watches the real estate versus stocks debate, because both sides promise a massive advantage, and the honest math says, at year 10, not yet. What changes after year 10 is something almost nobody in this debate talks about, and it's the variable that determines the real winner. Quick pause. If you're the kind of person who likes honest math that most finance channels avoid, go hit subscribe right now. We do this kind of deep dive every single week. It takes 2 seconds and it genuinely helps the channel. Okay, back to the numbers. 20 years. This is the moment the entire video has been building toward. Not year 5, when Ryan looked like a genius. Not year 10, when they were dead even. Year 20, when the math stops being theoretical and becomes undeniable. Let's build each number carefully, because this is where most finance videos either stop too early or skip the math entirely. We're doing neither. Marcus contributed $50,000 on day 1. He added $500 every month for 20 years. That's $120,000 in total contributions across the full period. $50,000 up front. $70,000 dripped in over time, at a 10% average annual return, which is the historical average of the S&P 500 going back nearly a century. His portfolio at year 20 sits at approximately $440,000 to $480,000. Let's anchor at $460,000 as our midpoint. He contributed $120,000. The remaining $340,000 is pure compounding. He did nothing for it. It happened because time passed and he didn't panic. He has never called a plumber at 11 p.m. on a Saturday. He has never chased a late rent payment. He has never had to decide whether to replace a roof now or gamble that it lasts another winter. He reviewed his portfolio maybe once per quarter. Call it 10 hours per year, 200 hours across 20 years. It's most of it casual. His portfolio is 100% liquid. He can access any portion of it within 24 hours. He pays no transaction cost to sell. There is no agent commission, no transfer tax, no closing delay. Marcus at year 20, approximately $460,000. Liquid, passive, done. Ryan's property has appreciated at 3.5% per year compounded. That is a realistic, conservative estimate for a solid residential market over 2 decades. $250,000 compounding at 3.5% annually for 20 years. Year 1, $258,750. Year 5, $296,000. Year 10, $352,000. Year 15, $418. Year 20, approximately $497,000. His 30-year mortgage at 7% on a $200,000 loan is now 20 years in. His remaining balance, approximately $150,000 to $160,000. Let's call it $155,000. Equity, $407,000 minus $155,000, approximately $342,000 in equity, plus net cash flow over 20 years, $60 to $120 per month, after all real operating costs, total between $14,400 and $28,800. Let's call it $21,600 at the midpoint. On the surface, Ryan's net position, equity plus net cash flow, sits at roughly $363,000 to $370,000. That is still close. That is still a meaningful number. But we are not done. The costs nobody totals. Here is where the real estate story quietly stops letting you look at the receipts. Property taxes over 20 years, $2,500 per year in year 1, growing roughly 2% annually as assessed value rises. Total across 20 years, approximately $50,000 to $60,000. Let's call it $55,000. Insurance over 20 years, $2,200 per year, rising modestly with inflation and rebuild costs. Total, approximately $24,000 to $28,000. Call it $26,000. Maintenance and capital expenditures. This is the one that catches every landlord off guard. You budget 1% annually, but 1% isn't a ceiling, it's a floor. Over 20 years, here is what a single-family rental actually requires. Roof replacement, $8,000 to $12,000. Happens once in 20 years. HVAC system replacement, $5,000 to $9,000. Once, maybe twice. Water heater, $1,000 to $500. Once. Appliance replacements across the decade, $3,000 to $5,000. Interior repaints between tenants, $2,000 to $4,000, 3 or 4 times. Flooring replacement, $4,000 to $8,000 once. Plumbing and electrical repairs, $5,000 to $10,000 cumulative. Landscaping, minor fixes, odds and ends, $5,000 cumulative. Conservative total for maintenance and capex over 20 years, $50,000 to $80,000. Midpoint, $65,000. That is not a bad landlord. That is a normal landlord with a normal property that ages normally. Total out-of-pocket costs beyond the mortgage across 20 years. Property taxes, $55,000. Insurance, $26,000. Maintenance and capital expenditures, $65,000. Total $146. In exchange for those $146,000 in costs, Ryan received $21,600 in net cash flow. Net out-of-pocket after cash flow, approximately $124,000 in real costs. Costs that Marcus never paid, never thought about, never had to budget for. Marcus's total contributions over 20 years, $120,000. Ryan's total out-of-pocket beyond the down payment, $146,000 in costs, partially offset by $21,600 in cash flow. Real net cost drain beyond the mortgage, approximately $124,000. They put in nearly identical amounts, but only one of them was working for his. This is the number nobody shows you. Not the equity number, not the portfolio number, the net number, after everything. Marcus, $460,000, liquid, 0 transaction cost to access. Ryan, $342,000 in equity, but to actually realize that equity, he has to sell. And selling a $497,000 property costs money. Agent commissions, 5% to 6%, up approximately $25,000 to $30,000. Closing costs and transfer taxes, 1% to 2%, approximately $5,000 to $10,000. Total transaction costs to liquidate, $30,000 to $40,000. Ryan's realizable equity after sale costs, approximately $302,000 to $312,000. Call it $307,000. Add back the net cash flow of $21,600. Ryan's true net realized position after 20 years, approximately $328,000 to $335,000. Marcus, $360,000. Ryan, $330,000. That is the gap. $125,000 to $130,000. That is what separates these two paths once you include what both sides quietly leave out of the thumbnail. And Ryan worked 800 hours across 20 years to close that gap down to $330,000. Marcus worked 0. That is the number this video exists to show you. Before I tell you who wins, I have to do something most finance videos are too afraid to do. I'm going to Steelman both sides. Because the comparison I just showed you, as detailed as it was, still has blind spots. And if I don't name them, I'm just doing the same thing every other video does. Building a case instead of building understanding. So let's go through exactly what each side quietly ignores. What real estate ignores? Your time has value. If Ryan spent 400 hours managing his property over 20 years, and that is a conservative estimate for a self-managed single-family rental, and his time is worth $50 per hour, That is $2,000 in real cost that never shows up on any spreadsheet. If he hires a property manager at 10% of monthly rent, $180 per month on $1,800, that is $43 to $200 over 20 years. That money comes directly out of his cash flow. It makes the passive income case look dramatically worse. Either way, the time cost exists. It just gets hidden in different places. Either it comes out of his wallet or it comes out of his weekends. Most real estate investors choose their weekends and call it passive. It is not passive. 2. Concentration risk. Ryan's entire $50,000, and then every dollar of equity built over 20 years, is in one house, in one neighborhood, in one city. If a major employer leaves that city, property values drop. If a flood hits that zip code, his insurance may not fully cover it, and his tenant leaves. If the neighborhood declines, his rental demand dries up, and his appreciation reverses. If a bad tenant stops paying and understands the eviction process in a tenant-friendly state, he could go 3 to 6 months without income while still making his full mortgage payment. Any one of those events can turn a 20-year wealth-building plan into a financial emergency. Marcus owns fractional stakes in thousands of companies across dozens of industries and geographies. No single event can take him out. 3. Liquidity costs. To access his equity, Ryan has 2 options. He sells and pays roughly 6% in transaction costs, approximately $30,000 on a $497,000 property, or he refinances and takes on new debt, resetting his mortgage and increasing his monthly payment. Marcus can liquidate his entire portfolio in 48 hours. No agent, no commission, no 30-day closing window. And if those assets are held in a Roth IRA or tax-advantaged account, no taxable event at all. What index funds ignore. 1. Leverage. Marcus could never safely borrow 5 times his investment to buy $250,000 worth of stocks. The margin rates are punishing, and he would be margin called into realized losses during the first meaningful correction. Real estate's leverage is structurally different. A 30-year fixed-rate mortgage at a locked interest rate is a subsidized multiplier that is not available anywhere else for the average retail investor. That 5-to-1 control ratio, $50,000 controlling $250,000, is genuinely unique to real estate. In appreciating markets, that single factor changes everything about the math. 2. Cash flow. Marcus's index fund pays approximately 1.5% in dividends annually. On a $200,000 portfolio, that is $3,000 per year, $250 per month. Ryan's property, even after all real costs, generates $60 to $120 per month in net income, and that income scales when he adds properties. The ability to build a monthly cash flow stream that gradually replaces a paycheck is categorically different from a quarterly dividend deposit. One is income replacement. The other is a bonus. 3. Tax advantages. Ryan can depreciate his property over 27.5 years, a non-cash deduction that frequently eliminates income tax on rental income entirely, even when that income is real and positive. He pays nothing in taxes on money he actually received. He can also execute a 1031 exchange when he sells, rolling his gains into a new, larger property and deferring capital gains taxes indefinitely. Done correctly over a lifetime, a real estate investor can die with appreciated assets and pass a stepped-up basis to heirs, meaning those capital gains are never taxed at all. Marcus pays capital gains taxes on every dividend distribution and on every sale. His tax drag is real, consistent, and unavoidable, unless he's investing entirely inside tax-advantaged accounts. Both sides have real advantages. Both sides have real blind spots. Which brings us to the only question that actually matters. Here is what 20 years of running every number honestly shows us. Real estate wins clearly when your local market has rent-to-price ratios of 0.8% or higher per month, meaning a $250,000 property rents for $2,000 or more. When you treat it like a business, screening tenants rigorously, budgeting for capital expenses before they happen, building systems so it doesn't run on your time. When you use the tax advantages, especially depreciation, which most landlords leave entirely on the table, and when you house hack, living in one unit and renting the others, eliminating your own housing cost entirely while building equity and cash flow at the same time. Index funds win clearly when you want simplicity, liquidity, and zero management time. when you will hold through market crashes without selling. And the data shows most people cannot do this without a system forcing them to stay in. When you're investing through tax-advantaged accounts like a 401k or Roth IRA, where your compounding is either tax-deferred or completely tax-free, and when your local real estate market has price-to-rent ratios that simply don't support real cash flow from day one, because in those markets, you're not buying an investment, you're buying appreciation and hope. The actual best answer for most people? Both. $50,000 split between a down payment on a cash-flowing property in the right market and consistent index fund contributions doesn't just add returns, it multiplies them. Real estate provides leverage, inflation protection, and monthly income. Index funds provide diversification, liquidity, and compounding with zero effort. Each one hedges the other's biggest weakness. The gap between Marcus and Ryan at year 20 isn't really $130,000 in either direction. In the scenario where they do both, it closes almost entirely, because the people who win biggest in this comparison are the ones who never picked a side. But here's the deeper truth that goes beyond Marcus and Ryan. Most people pick a side before they run the numbers. The real estate crowd says cash flow is king. The index fund crowd says compounding is everything. Neither of them is lying. Both of them are leaving out the parts that make their argument look bad. The trap isn't picking the wrong investment. The trap is optimizing for a feeling instead of a full picture. Ryan felt wealthy every time rent hit his account. Marcus felt nothing watching a number on a screen grow slowly. But feelings are expensive. Ryan skipped the hidden costs because they felt abstract. Marcus nearly sold at the bottom because the feeling of losing was unbearable. One path gives you the feeling of ownership before the math supports it. The other gives you the math before the feeling ever arrives. And over 20 years, the path you choose determines which one you end up with. So before you move your $50,000, ask yourself one question. Did I include everything? The maintenance reserves, the opportunity cost of your time, the tax treatment, the liquidity, the leverage, the behavioral risk. Because the answer that includes everything is the only answer that actually matters. If this breakdown showed you the numbers others won't run, hit subscribe. That is what we do on this channel, every single video. I'll see you in the next one.